此人生。
哎，Hello，那你有人吗？太好太好，我们刚好两个人。Hello。你看我多绿啊！还把我头上拿了。哦，小杨同志，哦，周小平，你今天你要做 presentation。啊，这哪里？啊，真的，我那时候刚讲。
Is this online?
不好意思。
所以就是
voluntarily. Thank you.
怎么说？我一看坐在这里。
Yeah, that's fine. Right.
Hello everyone, my name is Wang Ning. I'm the key organizer of TCFA Boston. Welcome to TCFA 2016 Boston Spring Reception. On behalf of the organizer TCFA Boston and Harvard CSSA, I would like to extend my warm welcome to everyone. Thanks for being here and join our discussion about the challenges and opportunities in emerging markets and China. TCFA, the Chinese Financial Association, was founded in 1994. Boston chapter is one of the largest local chapters. Please welcome Yimin, the co-president of TCFA Boston, to guide us through the history of TCFA. Thank you.
Thank you, Min, for giving me this opportunity to introduce the TCFA. TCFA, can we show the slides? Is that possible? TCFA stands for the Chinese Finance Association. It's founded in 1994. It's the largest global non-profit finance organization. So far, it has over 6,000 members globally. Most of them work in investment banking, asset management, or maybe other financial related agencies. And it has plenty of chapters. Almost like a couple of years, there's one new chapter being set up. Is headquartered in New York City. Boston is probably one of the most active chapter. The next one is the DC. Last year, we're adding 2 more chapters. One is the North Carolina chapter, one is the Los Angeles chapters, all with the help of the Boston chapter. TCFA has 3 major missions. First, to facilitate the exchange of the idea and source regarding financial topics. Along this mission, we have the annual conference, reception, seminar. Second, we serve as the bridge between the finance, between the US and China. We hope that in the end, we can bring all this power together, help develop the capital market in China. Finally, we help our members advance their career. So on this front, we give out all the job opportunities for free. And also we have the financial training program helping the members to pass the CFA. One of the most significant events at TCFA is the TCFA annual conference in New York City. It has a scale of over 700 people. For the past 21 years, nearly all of the events were held at the New York City, except in 2006. In 2006, it was held right over here at Boston. At that conference, Lawrence Summers, the former Secretary of the Treasury and for the President of the Harvard, was the keynote speaker. And other annual receptions that distinguished the speakers as well, like Dr. Robert Anger, the Nobel laureate in economics. At Boston, so far we have 1,400 members. It has existed for over 15 years. And this year, in 2016, we registered our own non-profit organization. It's called the Boston Chinese Investment Club. In this club, it will include all the existing TCFA Boston activities and the monthly gathering seminars and the services like the CFA training. So in Boston, we have annually, we have 2 large-scale receptions, like the one like this. One is in the spring, one is in the fall. Also, every month, we have the monthly gatherings. It's seminar-based. The most recent one is by the Ashley Grant, a State Street employee, a HBS graduate. She talked about the fixed income market in Asia and also the career development. Besides all these serious seminars, we also have the fun activity, and it's the summer golf outing. Every summer, we went out for golfing as a group, like 40, 50 people. It has been existed for over the past 7 years annually, and it is becoming more and more well-known. It's one of the well-known events at Boston among the Chinese people. Furthermore, other chapters are copying this idea as following the trend. So, as a member of the TCFA Boston, we have all these achievements, but without a great team, we can never accomplish this. We have a team of 24 people, and we have a team of really active, smart, creative people. And most of these people are here present and having set up this event with the Harvard volunteers, and most of them with an empty stomach for tonight. Let's give them another applause. Finally, how they can reach us? For 15 years, for the first time, we have our website. It's called bcicglobal.org. In this website, you can know our history, know all the historical events, and you will know how to join us as well. Thank you.
Thanks, Yimin. Today, we would also like to thank Harvard CSSA for the support. We have the president of Harvard CSSA, Sun Lu, here with us today. Harvard CSSA is the largest student group at Harvard University. It's also the most influential Chinese student group in the US. HCSSA is dedicated to promote the goal of social, intellectual, cultural activities for Chinese students and scholars, and also for other interested members at Harvard community. Last but not least, let me introduce our sponsor, Hengtian. Hengtian is Boston-based subsidiary of Insigma Hengtian Software. Hengtian is a strategic alliance among State Street Corporation, Insigma Technology, and Zhejiang University. Heng Tian provides IT staff augmentation, consulting service, application development, and technology research to the client worldwide. Let's thank Heng Tian for the sponsorship today again. China has always been under the spotlight recently. The topics about China, such as new exchange rate policy, the new economic transition, and also the volatile stock market, has always been occupying the highline. So that's why today we would like to focus on this topic and join this ongoing debate, whether it's a hard landing or soft landing. Today we will collect the Q&A through the website. So please follow the link, submit your questions during the panel. And you can also vote for the questions that you are interested in. So our moderator will select from the questions that has been liked most. So please have your phone with you and begin the conversation. First, let me introduce our moderator, Liz Su. Liz is working in Boston Common Asset Management. She is a member of firm's emerging market portfolio management team. And before this, Liz has served as portfolio manager in the Battery March Financial Management on the emerging market equity team for 7 years. Liz was also a former co-president of TCFA Boston, and she is still a dedicated director to the organization. So now let me hand over to Liz and begin our panel discussion today. Thank you.
Is people in the back can hear us? Okay, good. So I think we can just it'll be easier if we, So first of all, I want to personally thank all the volunteers and TCFA core members for putting this event together. As Dean mentioned, I actually have been involved with the organization now for more than 10 years now. And it's quite amazing to see how our organization has grown over the years and just the different types of events that we've put together and growing bigger and becoming very high tech these days that I can't catch up. So again, thanks all the volunteers. And tonight we have the great pleasure to have a group of very distinguished panelists here to discuss the investment outlook of emerging markets and China in specific. As we all know, emerging market as an asset class actually has underperformed the developed market for over 5 years now. It's kind of amazing, 5 years. And so, it's obviously at a lot of people's mindset. And when we decided on the title for tonight, the darkest before the dawn, earlier in January among the sort of global sell-off, we really thought we were pretty brave. And now, several months past, I think investors are becoming a bit more complacent with what I call the 3C fears: China, commodity, and credit. So emerging market actually kind of rallied for almost 20% from the January low. So the question is really, is this sustainable, and can we finally expect the emerging markets start to stabilize or even outperform? So I think tonight is a very opportune time for us to sit here and hear the perspectives from our guests, all of whom have decades of experience in looking at emerging markets. So without further ado, let me just briefly introduce our panelists. And sitting right next to me is George Hoggett. He's the Managing Director and Global Investment Strategist at the SSGA, and he's also on the senior leadership at SSGA. George requests me that I keep his bio short, but I know he has a lot of activities of affiliation. I know he managed emerging marketing at SSGA for several years, and right now he's working with large pool of capital, working on serious economic policy issues as well as portfolio strategies. George is a long-term supporter of our organization. many committees, Bretton Woods Committee, and he's the president of the Boston Economic Club, and he will be the incoming president of Boston Security, BSAS. I can never get the abbreviation right. And George also is a frequent speaker, and he has published in many industry and academic journals like the Journal of Portfolio Management, BIS, and Merger Reviews. George is a graduate of Harvard College and Harvard Business School. Right next to George, I have Wenhua Zhang. Wenhua is also very active in the Boston buy-side investor community. We also enjoy the lunch together in terms of debating stock ideas. So right now, Wenhua is the managing partner of Asia Capital, where he advises clients using both the ETFs as well as internally customized portfolios. And before he managed his own business, he was a portfolio manager at Harvard Management Company and also worked at Brookside Capital. For those who don't know, is the public equity arm of Bain Capital. And before that, he worked at T. Rowe for many years. He got his MBA from Wharton and his undergrad from China. And in his spare time, Wenhua also serves on the investment advisory committee for the city of Newton and the parents committee of Phillips Exeter Academy. And last but not the least is Geeta Rao. Geeta is currently the senior lecturer in finance and associate faculty director of Master of Finance program at MIT Sloan. I'm glad I didn't have a chance to take a class with you when I was there. This is some of my students. Yeah, raise your hand if it's some students. But actually, I'm looking forward to go back, maybe do a SIG class or something. Do they still do SIG? They do? Okay.
You can do anything at MIT, just pay money.
Oh, okay. Yes. So Geeta also is the founder and president of Asbury Capital. It's a consultancy focusing on quantitative analysis and portfolio strategies for institutional investors. Geeta has over 2 decades of experience in the industry, both as a research analyst as well as a portfolio manager. She managed a variety of strategies, global, long-short, asset allocation, as well as more balanced portfolios for both the institutions and retail clients. Geeta holds a PhD from the University of Rochester and MBA from the India Institute of Management. And Geeta is also very active in the community. She is on the board of trustee of the Research Foundation of the CFA Institute, which I believe George is also on. Right? So with that, what I'll do is we'll have our speakers give their remarks, and then we'll leave about 20-30 minutes for Q&A. So I'll ask you to sort of keep your question towards the end and look forward to the discussion tonight. First, I'll have George. George, the floor is yours.
Thank you. Well, good evening, everybody, and thank you for this kind invitation to the TCFA. I've been a member of the TCFA for more than 15 years, and I've made many friendships, but the most important thing from my standpoint is I've learned a great deal about China. So I wanted and made very good friendships. So thank you, Liz, for that introduction. It's very fascinating for me as a member of the TCFA to see the emails come listing all the different job opportunities, because it gives me an insight as to how the asset management industry is evolving. And it's great to see great job prospects for potential financial professionals, both in China and the United States. And one thing I just wanted to mention, Liz did mention that I will be the incoming president of the Boston Society of Security Analysts next year. For those of you who are interested in getting a CFA, we do have CFA practice exams, and I believe the TCFA is also administering those exams, so maybe there might be some scope for collaboration there. Few topics are as hotly debated these days as to the current state and future prospects of the Chinese economy. So George Soros at Davos said that a crash of the Chinese economy was inevitable, and many hedge funds, until recently at least, had a short on the RMB. Just today, Standard & Poor's reduced its outlook for the Chinese economy, taking its rating to negative. China is rated AA-, the US is rated AA+, but S&P said that its outlook was negative. So what I'd like to do in the next few minutes to frame the discussion, because China is so important in terms of what happens to the global economy and particularly to emerging markets, is to discuss the outlook for the RMB and really look at the question, is the RMB overvalued? And what the implications might be for global investors if we saw a maxi devaluation. The current spot market, the RMB has appreciated relative to where it was in January, but expectations are in the forward markets that it will depreciate a year from now by around 5%, and some firms like Citibank think that number is close to 10%. So there's significant disagreement as to what the true pace of economic activity is now in China, and of course whether the trajectory is going to result in a hard landing. Let me make 3 points, which is consensus has 53 economists up on Bloomberg argue that the mean estimate is at 6.5%. The Chinese economy is going to grow at about 6.5% this year. The IMF says 6.3%, and our own firm, State Street, is at 6%. But I strongly believe that risks are to the downside. Second point I want to make is that I think the RMB is in a range of fair value, but it can be expected to weaken over the course of this year and probably next year. And the third point I want to make is that the PBOC will defend the RMB and has been doing so vigorously over the past several weeks. But I do think that the risks of a one-off devaluation, while modest, may grow during the course of the year, particularly if China continues to lose foreign exchange reserves at the pace of around $100 million a month. I don't need to review, certainly for this group, China's enormous progress in recent years. Just to put things in perspective, China is now 15% of the world economy in nominal GDP terms. In purchasing power parity terms, China is the world's largest economy. It's anticipated that by 2030, in nominal terms, China will be larger than the United States. And China and the United States together account for 40% of global output. So for the world economy to be on track, it's obvious that these two economies have to be doing at least tolerably well. Just to put things also in perspective, if China grows at 6.5% a year, that's the equivalent of adding a Swiss economy to the global economy every year. So China is gradually reshaping the international monetary system, but is seeking to do so at a time when its nominal GDP growth last year was the lowest in 25 years. And of course, there's deflation in China. The GDP deflator is negative 5%. And of course, trend growth is estimated to be between 5.5% and 6.5% over the next 10 years, reflecting demographics, slower productivity, slowdown in world trade, and of course, something we'll talk about this evening, which is the great overhang of malinvestment. Well, the recent developments in the Chinese, I would say, macroeconomic policy and stock market have led to some confusion among investors And while the situation has stabilized, I still think, as I say, that risks are to the downside. So we had the crash in the stock market in August, June, July, and August of last year. Very hand-handed intervention. The market went from 5,000 to 2,800. There were circuit breakers put in place in January, then they were lifted. Of course, the head of the CSRC was removed, and now in a change of policy, the regulators on the one hand wanted China to reduce the amount of leverage in the system, but now they're actually facilitating in increasing it. There was, of course, the capital outflow. China lost around 500 billion in foreign exchange reserves last year, and about 350 billion of that was deemed to be support of the currency. And there was what economists call errors and omissions, which represents outright capital flight. There was confusion when the PBOC on August 11th announced a change in the way it was going to set the central parity. So previously, every day at 9:15, the PBOC would announce the fix. It announced that what it would do is the opening fix would be in relation to the change in the close of the evening before. So it was moving towards a more market rate exchange rate. Recall that there's a central parity and a 2% band around that parity. But in fact, in subsequent days, that wasn't the procedures that was followed. So we've had a period of enormous change since August, and during this time, at least initially, the governor of the PBOC was not very evident. The way the market was being communicated with was via the PBOC's website. So here you can see what happened. And of course, the exchange rate is one of the most important prices in the economy. Here we were, okay, there was this change in quotation, and this resulted in about a 2% devaluation. Then in January, there was an announcement of not linking, but referencing the RMB to a basket. This led to further weakening. And of course, Chinese policymakers are very nervous when there's volatility in the markets, and there was central bank intervention. And this slide is a few days old. There's been further intervention here, and the RMB has further strengthened. So relative to August 11th, it's off about 3%. Well, one of the points I want to make is that since 2009, the RMB in real trade weighted terms has appreciated by about 25%. And part of this was because of inflationary pressures. Part of it was because of pressure from the West. But clearly, the upward trend, which is something we've seen in many developing countries like Korea, Taiwan, has been an appreciation of the currency in the medium term, reflecting, of course, productivity gains. Well, the new basket that was announced is again a reference basket, and going forward, what people in the market should look at is how the RMB is doing relative to this basket, rather than exclusively looking at it relative to the dollar. You can see here the significant drop in reserves. So China's reserves were at $4 trillion, and now they're at 3.2 trillion. They're still high relative to GDP, about 30%, but market practitioners are concerned if this number continues to slide. So what I'd like to do is to ask the fundamental question, is the RMB overvalued? There are many cases of pegged exchange rates which have come under speculative attack, which have broken. And in fact, George Soros made his One of the big fortunes that he made was made on the strength of betting against the Bank of England when they were defending the pound in the 1990s. I do have, I think, in here a slide of the so-called policy trilemma, which those of you who have studied economics, I'm sure, are familiar with. But this is the notion here that a country can only have 2 out of the 3, but not all 3. So you can have a pegged exchange rate and capital mobility, which is the case of Hong Kong. But of course, Hong Kong interest rates track US interest rates, because if US interest rates rise and Hong Kong don't, money will come out of Hong Kong and be invested in the United States. Conversely, you have the United States, which has a floating exchange rate, monetary autonomy, and capital mobility. And then finally, there's China here with monetary autonomy and a pegged exchange rate. But of course, China's capital account is what I would call as semi-porous, and the measures that have been taken recently have, of course, tried to restrict movement of capital. Now, China, interestingly, coming out of the recent Party Congress, reaffirmed its desire to be a reserve currency. And reserve currencies are characterized, among other things, by having a floating exchange rate, deep deep bond markets, liquid bond markets, independent central bank, and of course, the free movement of capital. So on the one hand, you have this kind of medium-term desire, even short-term desire, to promote the RMB as a reserve currency. It's about 1% of the world's foreign exchange reserves. On the other hand, you have a clampdown on capital mobility going out, except for the going out program, and bank trying to buy a hotel chain. So there's a bit of a contradiction there, at least in the short term. I should mention that Zhu Xiaoxuan gave a speech today in which he said, as he said some years ago, that he wanted to promote greater use of the special drawing right, kind of a basket currency around the world, and that he wanted to promote bonds in China to be issued in SDRs, which I thought was quite interesting. So let's see here. Can somebody help me? Let's see here. See what stuff. Great. Thank you very much. Yeah. Okay, so I'm going to put forward, and my perspective is that of an economist and strategist, 3 models to think about the RMB. The first is, and I won't go into this in great detail, but it's a model called the Swan model. And this is a model that was developed by an Australian economist named Trevor Swan. And what he said was you can think about running an economy in terms of internal balance and external balance. So internal balance is full employment and no inflation. And external balance is a current account which is in surplus. Remember that China ran a current account surplus of around 10% of GDP. It's now down to about 2.5% to 3%. And in the Swan model, there are 2 policy variables. One is the real exchange rate, which might be considered the wage in dollars, and the other is real domestic demand, okay, the level of demand in the economy. So to have external balance, you can have a very highly valued exchange rate, but you need a strong level of domestic demand. Conversely, for internal balance, you need a weak exchange rate, and every point on this line represents a combination of the 2 where you want to be at point A. So point A represents full employment, no inflation, and it also represents a current account which is in equilibrium. Well, you can look at countries in terms of quadrants. And the point I want to make here is that China, in some ways, is not in equilibrium because it's off the external balance line, because it's still running large current account surpluses. $60 billion a month trade surplus, something that Donald Trump doesn't like very much, okay? And so by this metric, to get back onto the external balance line, you would want to move up here. You'd want to move up, which means you would appreciate the exchange rate, and then you would want to increase domestic demand to get into internal balance. So the question is the Chinese economy now in internal disequilibrium? So China's creating, 10 to 11 million jobs a year, okay? And of course, that's one metric. But some people say, well, if you look at deflation in China and the overhang of bad debts, that actually China is not in equilibrium. What I want to argue here is, for the purpose of this model, and all models are stylized, designed to help sort of explain and predict, is that this would lead one to say that the RMB is not particularly overvalued. China has a basic balance of payments of around $400 billion a year, and of course it has a surplus on the current account and on the capital account. But the nagging question is, are we going to see a slowdown where unemployment is going to rise? So just to give you another example of where countries plot, Greece, until recently, was up here. Greece had 20%, 25% unemployment, and it was still running a current account deficit. So this SWAN model, I think, is an elegant way to think about countries. Brazil is in this quadrant here. But the main point I want to make is that this would lead one to think that the RMB is not overvalued. Now we have at State Street, and there's a man named Roberto Rigobon, who's a professor at MIT, who's in a joint venture with State Street, and he has a very interesting index, which you could really call it the iPad index. Maybe you've seen in The Economist the so-called Big Mac index, the law of one price and purchasing power parity. And what Roberto does with his colleagues is he goes on the web, and every day in real time he's scouring prices. And so he's seeing what prices are for iPads and tradable goods, not untradable goods, non-tradable goods. But what he argues is that the RMB is about 10 to 15% overvalued, because if you look at an iPad, which I guess is the iconic kind of global good these days, that actually it's expensive in China. So that's another metric. And then the third thing I wanted to look at, which there's been a lot of work done on by the IMF, is what is the level of reserves that you need to defend your currency. So as I mentioned, there have been numerous examples of pegs which have been broken. Argentina, Brazil, Turkey, UK. And in order to defend the peg, you need reserves. So the IMF looks at, among other things, short reserves as a percent of short-term debt, as a percent of other liabilities, as a percent of M2 or broad money, and exports. And it all depends on whether you have capital controls and whether your exchange rate regime is fixed or floating. So China has capital controls and it has a fixed exchange rate. So it says that foreign exchange reserves as a percent of M2 should only need to be only around 5%. Now, these are just kind of rules of thumb. They're based on both theory and practice. And the IMF, like other economists and money managers, is sometimes wrong. So this is just a starting point for analysis. Well, the point I want to make here is that China's ratio of foreign exchange reserves to M2 is almost triple what the IMF recommends, assuming that the capital controls are effective. So one of the big questions going forward is, will the capital controls be effective given the anti-corruption campaign and the pent-up demand for people to get money out of China, which I think there is a lot of pent-up demand both to take money out of China and also to sell in the stock market, whether that will start to be kind of a contagious phenomenon. I think I need to press another button again, sorry. Not sure which one. Oh, there we go, is that it? No, that's it, great, thank you. Okay, so the point I want to make here is, again, we should look at the RMB relative to the trade-weighted basket. And what you can see here is actually that the RMB has depreciated by about 2%. So what the market will be looking at is not so much how the RMB does relative to the dollar, but how it does relative to this basket. So here are some key issues. Will capital controls be effective? How rapidly will China shut down the zombie companies, the SOEs? This is a key issue. What is the level of reserves that China will deem to be the minimum acceptable? You start running through a level of $100 billion a month or $150 billion a month in reserves. At some point, policymakers may get nervous, and there's a lot of debate as to what the acceptable level is. The minimum level might be around $2 billion. Some people say it's even higher. So, just a couple of other points as well known. There's been a very large run-up in debt in China, debt to GDP. There's been a lot of work done on predictors of financial crises. Jeff Frankel, who teaches here at the Kennedy School, has written a number of papers on this. And two of the better indicators are the pace with which credit grows relative to the crisis, and another is the level of reserves.
Before you switch, it's hard to read. Could you tell us where that ratio sits?
Okay, so this is, this is about this is as of the end of 2014, and it's about 210, 215, okay? This is low relative to Japan, but it's higher than many other emerging markets. And it's grown by another 15% or so over the last 12 months. So just a couple of concluding thoughts, which is that China has devalued before. So here was a devaluation that took place, which was 50% in 1993. Then it was pegged to the dollar. Then there was an undisclosed basket. Then there was, and bear in mind, this is an appreciation of the currency. Then there was a period during the global financial crisis when the RMB was pegged to the dollar again. Here's the appreciation that I showed in the previous slide. The real effective exchange rate is calculated by the Bank for International Settlements. And then here we saw this most recent round of weakening. So what I just want to suggest is that there is some historical precedent here. Again, it's not the core forecast, and I think it's obviously, like with Janet Yellen, going to be data dependent, but there are a number of factors that have to fall into play for the RMB to maintain, I would say, a relatively smooth decline. So what happens to emerging markets in the world economy? Well, there certainly will be a negative, if there is a maxi devaluation, a negative impact on commodities and commodity currencies, spillovers to Asian currencies, because many more Asian countries now certainly have, if they're pegged to a basket, the RMB is a major component of that. Obviously, increasing trade tensions. I think one of the reasons China were not engaged in this is precisely because of the U.S. electoral cycle and the trade tensions that have been discussed. And another aspect might be domestic political repercussions in China. There's been some very interesting work done by political scientists that have shown after maxi devaluations over many course of many years in many countries that actually governments have fallen in democratic societies. So devaluations are not particularly popular. Well, if you're a corporation, you try to hedge one way or another. Just couple of other final points. It's not clear that a devaluation in China, whether it would be expansionary or contractionary. The reason it might be contractionary is that there are a lot of Chinese corporations that have dollar-denominated debt. So there's about $800 billion in dollar-denominated debt. If there were, let's say, a 15 or 20% devaluation, the cost of the debt service would go up. So let me just conclude. China is not an external disequilibrium. There has not been a change to the median consensus of among 53 economists that China will grow by 6.5% this year. But I do think risks are to the downside. As I mentioned, there are many examples of unsuccessful defense pegs. Political considerations, as we know, are equally important as economic decisions in China's exchange rate policy. It would be very much in China's interest, I think, to widen the bands and to have a much more flexible exchange rate. And obviously, if there were a large devaluation in China, it would impact the global economy, particularly through financial asset prices. But the real effects would vary significantly by region. Obviously, neighboring countries, Hong Kong, Taiwan, Korea, would be most seriously impacted. So I thought I would just kind of lay the framework for the discussion in terms of China.
Thanks, Joseph. There's a lot of very key points. There's a lot of debates and competition every day. I know I have a lot of questions, but let's hold on to that, and then we'll have one part. If you remarks first, and we'll have the discussion.
Thank you. Hi, everyone. Thank you, George. This is really, I learned a lot from it, so I really think that this is excellent in your analysis, and I think I agree with almost all the points you are talking about. I am not a macro person. I am someone that's called a stock picker. So the fund I do is essentially a combination of long-short fundamental equity and also have a component called event driven. And one thing I want to say is macro is very important for investing almost in any country you engage in. But for fundamental active management, the most important thing is actually to find good business. To find a business that basically have a defensible franchise with decent management team, and you should generally pay a fair price for it. But unfortunately, the market has been very volatile, so it's quite difficult to basically try to generate alpha as an active manager. Especially if you are in the institutional setting where you cannot actually hold many of the things that you think, maybe even things you want to hold, but there is something called index. Index is something that you are measured against every day. And if you are in a very institutional setting, there is a lot of risk limitation of how much you have to do in terms of indexing. Even though sometimes you don't disagree, but for the sake of keeping your job, you just have to be indexed somewhere. And I was in that world, and then I stopped and tried to think about what do I do if I'm investing money for myself and for my friends, for families, for the people that trust me with the money. So essentially, I want to show you a chart of, so I started the fund last year, in February last year, and the blue line is the fund, and the green line is MSCI index for Asia Pacific. So you can see, generally, the active management in this case does add value. But you have to be ignoring the index for some period of time and just focus on what is decent company you want to own. Okay, so I'm going to close this out and go to the presentation that I have, which essentially is a very simplified version and repeat many of the things that George has already talked about. So I think I might just skip it and talk about the older version. And really talk about what I learned in time of financial crisis. Then don't, yeah, we don't need to show it. So I just tell you a story. So okay. I'll just spend 1 minute on the version I prepared. So essentially, I have a few titles. Is the lowest of the last 2 decades, and it's probably heading lower. And the second is China still matters to the world and have almost the same data as for the percentage of GDP is 15% versus, so Europe as a continent is 15%. So generally they're at very similar levels. But so the question is, if China really have issues, will that actually trigger U.S. recession? And the Goldman's opinion is it's not going to be, because the impact is generally modest. And this chart is exactly the same. It shows 218% of debt to GDP ratio and is rising very rapidly. And I completely agree that generally if you have such a speed of increasing debt, and there's a lot of efficiency that can be embedded in how you are lending, and generally it's a very dangerous level to be thinking about. So yeah, so I also think RMB depreciation could continue. And from this slide, I actually think for all the gloom and doom we're talking about in China still have a lot of potentials. One of the potential is there is a lot of government regulation in China. And those regulations today is still stopping many of the creative force that can be unleashed. I have an example that somebody told me a story about something about corporate registration. It's something called a registered capital, which is 注册资本. And this is something that in the past, you have to basically demonstrate you have, let's say, 1 million RMB in the account, and you have something called 验资, which verify how much money you have. And I think that regulation was abolished not long ago. And suddenly there was an explosion of new company being established. And this is just a small example. Think about how many things the regular Chinese citizens can do if you abolish all the entry barriers into different industries. How much consumption you can unleash if you really allow the migrant workers to feel like the city is their home. They need to buy a TV, they need to buy all the things, they actually need to buy an apartment. Maybe not in Beijing, Shanghai, because those are really the cities that have the problem at a population limit. But for second, third, and fourth tier cities, if you have really a policy like this, and also give the farmers the ability to monetize their asset, which is their land, you can actually unleash a lot of consumptions. So for a fundamental stock picker, I feel like that's an area that if you focus on the service companies, and focus on company when they're selling at a very cheap price, especially if there is some sort of hardship or financial crisis. You may actually get a bargain of actually a very, very good growth business at very low price. So actually, don't feel like that's by nature or bad for investors. And also, this chart shows the growth rate of the private sector has been above SOE for consistently over the last decade. So my takeaway is I do have a lot of cautions for the traditional industries, but I see opportunities to invest in high quality companies during this process. If you can really be patient, if you have enough liquidity in the portfolio, and you really believe in some of the companies, when the market actually presents opportunities, that may be the best time to step into it. So thank you.
As mentioned, our guests all have decades of experience looking at emerging market, but emerging market is really not it's very diversified. There's so many assets, and there's a lot of ways of looking at. George look at from a very top-down, macro perspective. One part look at very bottoms up, picking the right companies. I personally, my company, Boston Company, we are ESG managers, so we look at companies from a sustainability perspective. So there's a lot of different ways trying to play within the emerging market. So I think it's a great, and also, I say this to this Gita, look at more from a more systematic and quantitative way. So, we think, the group here today, we actually very diverse approach, even just looking at emerging market investment. So now I have give the floor to Gita to make a few words.
So everyone having fun? These people are awake. That's an achievement. 8 o'clock, and people are still awake Thursday night. I know you'd rather be somewhere else. So when I was invited to participate, my first question to the organizers was, why? Why me? And they said to me that I've been investing for a long time, which is very true, and that I think differently. And differently is not always good, but I do think differently. So I've been investing for over 20 years in global markets, and China has been a piece of the portfolios that I've managed. As was mentioned, I think I take a quantitative lens, so I tend to look at things in a more systematic fashion and try to blend the top-down macro stuff with more bottom-up stuff. And so I think many of my comments will again echo what George said and what Wenhua said, in the sense of I think we're all kind of picking out threads in the same tapestry. But I decided when I was trying to put comments together, I decided that, just like Liz said, you have the 3 C's that are causing so much volatility: China, currencies and commodities. There's a fourth, which is a D, and that's Donald. And so I decided I'm going to stick to China. I don't want to go beyond China and think about the US market in China. This is something that is sort of unfathomable, right? So let me see if I can figure this out. There you are. Okay. So Okay, so when I was thinking about this topic, I decided to look at it in a way that people have mentioned, which is China's really at a crossroads. When you look at it from the outside, I'm not Chinese. I've traveled there. I have a lot of students who are Chinese. I have friends who are Chinese. I've been investing there. It's really at a crossroads. This is a country, an economy in transition. And when I thought about in what way is it in transition, there's the old China, which is the China that has built up and that has come to this certain point, to this point to discuss. And then there is the China that is, that looks forward, that is looking ahead. And I thought it'd be interesting to examine both the old China and the new one, the one that's looking ahead. And the common link here is the phenomenal economic miracle that has been wrought by the policymakers. When I think back, I'm from India, and in 1948, India and China were exactly the same in terms of the WHO indicators. Infant mortality, literacy, GDP per capita. And I look at India today versus China, and it's an unbelievable thing what has been done. To lift 500 million people out of poverty, abject poverty. It takes incredible focus, discipline, and it's an amazing achievement. But like in life, just like everything else, there are consequences, right? There are consequences that are anticipated, and then there are unanticipated consequences. Thank you. So let's look a little bit at what these consequences have been. And again, I think George and Wenhu have touched on some of these. But we've got a problem where in at least a dozen industries, they're saying 16 is probably the number, huge amounts of excess capacity. So the capacity has to shrink for several reasons. One is because it's dragging down growth, but another reason is there's a lot of pressure internationally because China is taking that excess production and dumping it. So there are a lot of cases in front of the WTO, huge number of cases brought by a number of different countries against China. So China is under pressure to, externally as well, to take this capacity down. What that means then is the labor force has to shrink, right? In accordance with shrinking of capacity. Now, what does that require? If you're going to then lay off people, where do they move to? What should they do? What kind of retraining is going to take place? Migrant labor is something like 20 to 25% of the population. What are these people going to be doing? They're people who are employed in steel, cement, coal, paper, black glass, you name it. What are they going to do, right? So that's, these are some of the consequences. Another consequence of a very, very important policy decision, the one-child policy, is that now we have very unfavorable demographics. And I'm going to talk a little bit more about that. And finally, the last two things I want to mention is environmental issues, which I think, I don't need to say too much about it, but the huge environmental air, water, soil issues, pollution, and China is still 45% rural. So you've got a rural population of almost 700 million people that have needs that that have to be met, whether it's water, sanitation, basic stuff, public health, these sorts of things. So let's see here now. I don't know what it is. I cannot figure this out. It has to be me. So when we look at this, when we look at the consequences of all this growth, we start thinking about it like George said, you cannot think about economic policy without thinking about the political imperatives, right? So what are the policy imperatives that the government is facing? So can somebody tell me what this is? What's that?
Iron rice bowl.
The American tells me that. So I was told by one of my students that if I want to have a some people are looking very puzzled. How many of you recognize it? Okay, so some few people. Okay, so this is the iron rice bowl, which I guess this is a generational thing. So apparently, so you see, you think of China and when you try to draw parallels, one of the parallels I draw is with the Eastern European countries that came out of communism, right? Once the Soviet Union broke up, and they had an equivalent to the iron rice bowl, which is the notion that there was a safety net, that if you had a job, you would have healthcare, you would have education, you have the basics of life. And the broken iron rice bowl suggests that people don't have that anymore. That they're concerned about what's going to happen to them if they lose their jobs. So can somebody please, yes, you guys know, right? So can somebody translate this for me? Can somebody read it out? How about you? No, I'm just kidding. I thought maybe you would know Chinese. Anybody? I hope I got it right. I asked one of my students, and she did it, and then I put it into Google Translate. It was a little bit off, but so can somebody tell me what it is?
We have to decrease the capacity, the industry capacity, so that, however, we need to make sure those employees keep their rights full, so that we have to create new role for them.
All right, very good. Very good. This was 2 weeks ago. The Prime Minister said this, and I think it's very poignant because what this is saying is that when we look at it through whether it's a portfolio manager lens and economist lens, we are saying, oh, China needs to do this. They need to shut down these factories. They need to lay off these people. The reality is these people have no food then. That's the metaphor of the iron rice bowl. There is no safety net. They're unemployed. They have nowhere to go. And what they're saying is we have to make sure we have some backup plan for them. So far they've announced, in the Rust Belt provinces of the Northeast that they'll do about 15 or 20 billion. But it's going to have to be a lot more than that, right? So let's think about what are the imperatives. So like we mentioned before, shrinking the surplus capacity while avoiding economic disruption, and this is a very important thing in China, social unrest, as George mentioned before. When I started looking and asking people and reading, the estimates of potential job losses are all over the map. They announced that 1.8 million people will be laid off from the mines. But then they said, oh, we're not going to do it. It may be 3 million. Some people are saying, 10 million people will need to be laid off over the course of the next 5 years. So let's, just to put this in perspective, China has a working population of about maybe 600 million people. Do you think that sounds right, George? No. Yeah. Now the US, at the height of the recession in 2009, when the unemployment was 10.5%, there were 15 million people unemployed in the US. Okay? But we didn't have riots in the streets. There was no question of social unrest. Yes, it did spark, Occupy Wall Street and this and that, but it did not cause the government to pause in terms of what kinds of policy levers they were going to use, what they were going to do. The Chinese government is in a very different place. I was thinking about it, 10 million out of 600 million people are working. But something, all you need is 1,000 people to really create problems, right? Social unrest does not take a lot of people. And the imperative for the government is to prevent that, to prevent this sort of thing from escalating and threatening the political fabric. It is a huge imperative for them. So what is the takeaway for us as investors? Whatever needs to be done is going to be done very, very slowly and judiciously. Very, very slowly. It's not going to happen fast because of this. The second thing is surveys. They've done surveys of tens of thousands of Chinese people, and again, you compare them to what was done in Eastern Europe, after transition, and people say we have more money, we have more things, we live in better apartments, but we are no happier. And when they ask them why are you not happier, they cite various things. They say we are insecure because there's no social safety net. We need services for old people. We have moved away from our families. We are, there's one child, and they've got 2 sets of grandparents. Who's going to look after these people when they get old? We need services for our children. Who's going to look after my children when I have to go to work? All of that sort of stuff. And they say this environment is killing me. People say this, regardless of where they live, unless it's a remote rural place. So the government, all of these things are imperatives for the government as well, right?
So again, they're balancing, trying to reduce capacity so they can stimulate growth against the need to spend money on all of these things. So I'd like to spend a little bit of time on demographics. For a while now, I've been investing in Japan for a long, long time. And for a while now, I've been thinking that when you look at the demographics today in China, it reminds me a lot of the demographics as they were in Japan back in the 90s. And so I went and I pulled some data, and this is actually, I think it's Eurostat or, it's the EU Chamber of Commerce. And what I found was very interesting. In fact, there is a lot of similarity that Japan in the mid-90s was a lot like China is today. I don't know if you can see that. I mean, if the numbers are large enough. But the age dependency ratio is roughly about 40%. And of course, in Japan, as you can see, now it gets much worse and worse to the point where you've got for every person who's employed, you'll have one person, at least one person who's dependent on them, if not more. So I started thinking about this. What else is similar about China and Japan? Back in the 90s, currency under pressure, capital outflows, dependence on imported oil, bloated enterprises, very inefficient enterprises, banks that were absolutely weighed down with debt. So is China then in for a kind of lost decade, the way Japan was? And I was thinking about it, I said, no, it's not. There's a lot of reasons why China is not. Number one, China has population. Japan was so much smaller, so much smaller. I mean, we're talking orders of magnitude. So China has population, and China has young people, which is important. Number two, Chinese culture is entrepreneurial and risk-taking. And as Wenhua mentioned, as more and more private enterprise is being allowed to operate, this entrepreneurial spirit is just getting stronger. Japan has had a history of not having an entrepreneurial culture. So I don't think, even though the demographics don't look great, I don't think that that's necessarily negative for China. So let's look a little bit now at what the opportunities might be that, as investors, given what these adverse consequences are that we've identified in the what I'm calling the old China, the China that is bearing the consequences of all of the growth. The senior living, home health services, huge growth space. There's a lot of private equity firms that are operating. So if we step back and say, how can one participate? Unfortunately, there's not a lot of public, listed sort of ways to participate in some of these things. But that doesn't mean one shouldn't look at them. I think it's worth looking at. So there's venture and there's private equity. So there's at least 3 or 4 private equity firms that are very active in the senior living space. As seniors are living longer and they want, just like seniors here, they want their hip replaced. My aunt is 87, she just had a knee replacement. I said, oh, why do you want to have your knee replaced? She said, why? If you can have your knee replaced, why can't I have my knee replaced? Okay. So people had expectations that they should be mobile and do stuff. And then, with the children far away, that culture of living with your children and having them take care of you, that has, is gone, right? Because the government forced migration. So you've got the need for people to be living by themselves and having people assisting them. So that's this area. Adult education and retraining. I don't have any ideas how one can play this space. I think this is very difficult, but it will have to be done. And in India, there's there are public-private partnerships that are trying to take people, rural people whose their farms are subproductive, and they're giving them skills. So teaching them computers, teaching them data processing, stuff like that, so that they can at least start tiptoeing towards becoming some kind of knowledge workers. Water, air, and soil purification. This is a particular sort of hobby horse of mine. The picture I've got on the right-hand side is I actually have one of these in my office because I asked a student to get it for me. It's a home water purifier. I thought the water in India was dirty, and nobody in India will drink water from the tap. But what I was horrified to find out from my students is that in large cities in China, it's very common to have heavy metals in the water, like mercury and cadmium, I mean, incredibly toxic metals. Because of the industrial effluents, the wastewater, it's just washing down. So this thing, having, and the technology basically hasn't changed. It's that reverse osmosis kind of filtration thing. There's some big players. A.O. Smith from the US is a huge player. EDF in France, these companies, but some of the Chinese companies are moving into it. Haier has got something. Xiaomi has something, which is one quarter of the price of that the other guys sell it at. But apparently the problem is water is not clean. See, that's the thing. I mean, ultimately the water should be drinkable, right? It doesn't matter whether the price is 1/4 or 1/10 or whatever. So, but I think this is going to be a huge area. The government's putting money behind it. And then, as Liz mentioned, if you're looking for ways to invest in China as it stands today, sectors and industries that rate highly on what is called ESG, environmental, social, and corporate governance metrics. Because these are companies that are taking the long view. These are companies that are focused on this, regarding thinking of a stakeholder perspective as opposed to a shareholder perspective. And these will be companies that will, have earnings quality that will deliver over the long run. That'll be more stable and you'll get good returns. So I would, strongly encourage people to look at that. So now coming now to the new China, which is the world that most of you have grown up in. And how many of you have used a fax machine? Okay, it's a good number here. Okay. How many of you have seen an old cassette recorder? A Walkman kind of. Oh, okay, so you've got like 3 people, right? Yeah, my daughter was looking at one of them and she said, "What is that?" Okay, so who does not use WeChat? Yeah. Manny, what do you use? WhatsApp, right? WeChat or WhatsApp, that's right. So my assistant said, "Oh no, this looks very bad." But what I did was I got a list of the top things that were gifted in China in 2015. And the lady didn't come with the car, it was the car. So I'm sure the person who bought the car, if it was a man, would have liked the lady to come with it. So it was luxury cars, it was iPads and so on. The selfie thing, the selfie stick was a huge seller. And then there were a few other things. There were handbags and stuff. I took that off. I was having too much fun doing this. But stuff like the diapers. Now this is a very interesting play. So Chinese consumers would rather buy Japanese diapers, from Unicharm. Liz is shaking her head. Yes. Yeah, exactly. And Unicharm is a great company. I like Unicharm because they make adult diapers. Because that is the fastest growing segment in Japan, right? The adult diapers are growing much faster than baby diapers because it's a negative birth rate.
Number 1 market share.
Exactly. So Unicharm has moved in a big way into India and into China. They can't go into Brazil because Kimberly Clark has got a lock over there. But so it's a Japanese company, but it's a play on China. And there's many ways to play this, right? People are having children. They want to give them the best. They're worried about milk. They're worried about giving, having proper diapers, good education. These are all ways to play it. So the consumption, the numbers are just, everything about China is so oversized, but $615 billion e-commerce in 2015. That's the US and Europe combined. And this is only just getting started. I mean, these are staggering numbers. And then you look at R&D, you look at companies like Huawei, you look at what the government is doing in terms of investment in life sciences. China spends currently only about 7% of GDP on health, which is way below the region as a whole, but that includes Korea and Japan. But it's below India and so on, so there's a lot of catch up. The plan for, the national plan says by 2020 there'll be a public health clinic in every village. I mean, you can imagine the kind of resources that have to be put behind that. Mobile commerce. I mean, this over 50% of transactions in China today are taking place on phones. Over 50%. So, mobile wallets, so on. And you mentioned that, Wenhua. I mean, this is an incredible space. And finally, this fintech. This is another hobby horse of mine. A company like Lufax. Who knows about Lufax? So Lufax is owned by Ping An, the insurance company, and they have a peer-to-peer lending platform so that when you go to, and I've actually seen this demonstrated, you go to buy a car in China. Now, that's it. You go to buy a car here, right? You go to the dealership, I want to go, I want to buy this car and talk to this guy. You go buy the car, then you call up your insurance company and you tell them about this car, and then they get the details, and then they do this and that and the other, and you finally get your insurance and you can drive your car. You're all very young, you don't have cars. Eventually you will have a car, maybe many cars, right? What Lufax is doing is as soon as you buy the car, you get ads on your phone with quotes from different insurance companies. And you can compare the quotes, you can compare the coverage, just click on it, it's there. This is disintermediating the insurance company. There's a huge amount of disintermediation of banks going on with peer-to-peer lending. So this is all, I think, just really going to pick up. And you mentioned travel, and I actually, when I go on, I'm going to show you something. This is, I don't know how you say it, Q-U-N-A-R, how do you pronounce it? Tuna. Yeah, Tuna is that, the travel company, online travel company, so I put their little thing there. The reason, I'll tell you the reason why I put it over there. Okay, so now we get to the numbers. Again, this ties back to what Wenhua was saying. Look at the index. This is the MSCI China as of last Friday, okay? And this is the sector breakdown. I'm sorry, can you read the numbers? Sorry, they're a little small. I'm not very good at PowerPoint. It's not my strong suit. I'm sorry. I think what stands out over here is, where's the name? Where's the pointer? Yeah. Oops. Oops. Sorry. Where's the laser thing on this? Where's the laser? Oh, that's what's off. Which one? Oh, that's great. Okay, thank you. All right. So I think what I'd like to point out over here is, for instance, take a look at financials. Still over 35% of the index. So a third of the MSCI China index, over a third is still financial companies. Of that, banks are 28%. Okay. But then look at technology. Technology is now 24% of the index. And within that, most of it is software, 15%. Consumer discretionary is small but rising, 6%. And what else? I think it's interesting to healthcare is only 2%. And finally, energy is down to 7%. So what I would say, looking at this, if you are investing in China and looking at the index, really it's a play on the financials. That's all it is. And these financials are weighed down with non-performing loans. So really, when you look at China and you think about China as in terms of investing, you have to go dig deep into the index. It really is reflecting an economy in transition. So now I decided, let me try to do something where I'm looking for growth. Where would we look for growth? So I went into FactSet and got projected sales growth rates for all the companies in the MSCI China index. So this is, the fiscal year one. This is, for the next fiscal year by sector. So I aggregated them by sector. And the ones I've highlighted, so the difference between the two panels is the one on the left, for example, if you look at consumer discretionary, that's all the companies in consumer discretionary. Their 1 year forecasted sales growth on an eco-weighted basis. The one on the right side is, it is weighted by their size in the index. So it's the cap weighted. The difference between those two tells you that what is going on with mid-cap and small-cap companies in China. So when you look at this, for example, consumer discretionary, the large-cap companies are just not growing. It's the mid-cap ones and the small-cap. The same thing is true for, if you look at information technology, 6% on a cap-weighted basis, but 31% on an equal-weighted basis. So the opportunities are in the mid-cap and small-cap space. Again, there, you have to do a lot of fundamental research. You really have to know your companies, and security selection is very important. I did the same thing and looked at industries. So digging even deeper into the index and said, okay, let's look at the top and bottom industries by forecasted sales growth. Now, mind you, forecasted sales growth is not a perfect thing, but I don't want to look at earnings because earnings in China are very suspect. They're prone to manipulation, and it's not a good measure. Sales is harder. It's harder. It's not impossible, but it's harder to manipulate sales. And besides, sales is a very pure organic number. You want to look for companies that are growing sales, right? So now if you look there, I mean, these are also very interesting numbers. You see that for, when you look on the left side, this is all, you've got automobiles, you've got software, and internet and catalog retail is 48%, which is not surprising, but that's a staggering number. On the right-hand side, you have banks at negative 34%, and then diversified financial services, negative 24%. Again, this backs up that whole story that you have to be very careful what you look to invest in. So then I dug a little bit deeper and I said, okay, let me look within consumer discretionary, the sector that had that very high growth rate in the previous slide. What kinds of companies do we see here? So this is the consumer discretionary sector within the MSCI China Index. And I've highlighted some of the companies there. BYD is a company that makes the batteries, the one that Warren Buffett has a stake in, 44% forecasted sales growth. C-Trip. How many of you have used C-Trip? Okay, great site. So, online travel, it's another thing, really playing on the consumer. JD, anyone use Ding Dong? Yes, okay. All right, so you've got internet, and then New Oriental. I'm hopeful that New Oriental will branch out into retraining, right? And go from this, cramming schools and stuff. And finally, this Chunar, right? Okay, I have to try out their site as well. But look at the growth rates we've got here. These are staggering numbers. You look at this, and would you say this is an economy that's on the skids? No. So we've really got a very schizophrenic economy. That's what's going on here. All right. So I think it's time to conclude. As I mentioned, I think looking within the index is really crucial in China if you want to make money, and security selection is paramount. This is both in terms of equities as well as in terms of debt. I'd love to chat about debt if we haven't brought it up, but it'd be interesting in the Q&A. As Wenwa mentioned, tech and the consumer and services all appear attractive. I would also put healthcare in there just because there's such massive investments being made in life sciences. Those are going to pay off. Environmental remediation. I know this is a controversial one. Some people feel this is not going to be, at least in terms of as an investment, this is going to be a hard one because the state is going to own most of it. And finally, again, just to frame it the way the other speakers have, dealing with the fallout from this transition is going to be challenging on an ongoing basis for the government. So it's going to be very slow, and it's going to be deliberate, but I'm confident that they'll engineer a soft landing. Thank you.
Thanks so much for our panelists. It's very, very interesting. And before we start the Q&A, let's take 3 minutes to enjoy a short video from Harvard CSSA. And at the same time, you guys can take a look at the question list. And please vote for the ones you like and also submit your questions. Our moderator is collecting the questions. Thank you.
The questions will be asked.
Yeah, we will already have like a very long question list. So here, please enjoy the video.
我觉得从我一开始刚来到哈佛就有 HCSIC 的同学接机，之后又有很多的学术讲座，还有很多职业生涯的规划的帮助，包括有很多出游的机会，给我感觉很温暖。HCSIC 就像我自己的家一样。
我的父母赋予了我这样一个名字，就是希望我具有贡献精神。来到哈佛 HCSSA， 我确实找到了这样一个组织。
HCSSA 呢是一个桥梁，它连接着哈佛以及大波士顿地区华人学生学者与祖国日新月异的变化。
那我们希望呢，大家能在我们的平台上找到校园生活中更多的乐趣，建立更符合自己的职业发展方向。那更主要的呢，是建立一个长期的友谊和信任。
HCSSA 像一个摇篮，培养了一代代哈佛学生领袖，大家一起为工作的成长探寻服务的意义。在为这个组织付出的第4年 ，HCSSA 对我来说，已经不仅仅是一个锻炼的平台，一个温暖的家庭，它更是一种责任。哈佛大学中国学生学者联合会 HCSSA 成立于1994年，经过20年的不断努力，已经成为哈佛最大的学生组织，并逐渐成长为全美最具影响力的华人组织之一。从长春道盟校春节联欢晚会、哈佛中秋晚会，到千里慈善长跑、体育休闲外出，从100余场哈佛大学名家讲坛、职业发展讲座，到新生服务项目、新生接机，还有新生欢迎会。我们的团队从最初不足10人，壮大到今天超过30人，分管9个部门、3个俱乐部，每年开展4项大型活动。我们的会员从最初不足100人，发展到今天近1万名会员，和社会各界人士一起参与我们的各类活动。
哈佛的同学们，新年快乐！我们马上要给大家拜年了。
朋友们，大家好，我是教练袁建坤。哈佛大学的华人的同学们，你们好，我是齐行。
Hello， 所有哈佛大学的同学们，大家好，我是方雨涵。新年就要到了，在这儿祝所有的同学们新年快乐。
什么是 HCSSA？ 是学业之余可以放松的大家庭，是分享交换价值的资源网络，是哈佛人一起成长、创造影响力的平台。学生会的故事需要我们一起来书写，学生会的平台需要我们一起来搭建。
和这样一帮志同道合的朋友们一起工作、一起进步，会为我哈佛的整个生涯增光添彩。
希望大家来到 HCSIC 也有到家的感觉。
Thank you, everyone. For Charlie let me quickly transfer. In conclusion, Harvard HSA is a home for all the Chinese students.
Thanks for hosting me and also inviting me. Before we do the Q&A.
So let me hand over to Lisa and start our Q&A session.
Lots of great questions, and also there's the 点赞 as well, which is like very good. So I should maybe we start with the first one, if I may, because it's very topical. So because this actually goes to one of the questions that George you talked about, sort of the what's the demand? You know, you remember the SWAN model.
Right.
One thing I always think about is, to answer, I don't know the answer to that, but I think the key challenge for China is really the capital misallocation or inefficient way of allocating capital.
Right.
You know, do we really have enough demand or not enough demand? And that is really kind of amplified in the real estate market.
Right.
You can, I mean, a lot of people would say it's a bubble. You know, everyone thinks the real estate market in China is a bubble. You look at 3rd tier, 4th tier city inventory, whereas in you know, 1st and 2nd tier, the price is hijacking.
Right.
The question is related is that when, because in a property market is still purchase constrained, and then whenever we can loosen that a little bit, have a little bit of stimulus, prices went up. So I think the question is, how do you see the recent you know, flying real estate price in China? Is this, you know, does the control work? And is this, I know, grand finale and, you know, are we towards the end of the bubble as well?
Well, one of the problems, this is well known in China, as you alluded to, is the overhang of properties in the tier 2, tier 3 cities, where in some cases the inventory is as much as, I've heard, 18 to 24 months. And of course, that can potentially back up on the banking system as well, as there are bankruptcies and potentially also wealth management products which are related to the property system. One of the phenomena that gives me some confidence that China will get through this period of slow growth with not too much damage to the economy is the fact that China has policy flexibility. So unlike the United States, I should say Europe and Japan, where at the zero lower bound we have negative interest rates, China's got a long way to go to cut. And we've seen this in terms of the required reserve ratio, which is also when working with. Also, we've seen some fiscal stimulus. So I think that what's taken these markets up recently has been the fact that there has been some evidence of loosening of policy and expectations for further rate cuts in China. This is a big difference between China, for example, and the Eurozone. But of course, the property market reflects the bubble conditions to some extent, reflect the lack of sufficient outlets for savings in China. So if there was more capital account convertibility or a better developed financial market, I mean, it's very interesting to me, why did the Chinese authorities feel the necessity to intervene in the stock market? Of course, we intervened throughout the West to save our financial institutions. We banned short selling, but the reaction, rather than letting the market clear, was to try to support it. And of course, in some ways, it worked, but it's still the market's overall. So there's been a loss of confidence, is what I'm going to say, in the stock market, and some of the funds have probably found
When you think in the US, I mean, one of the things people do is put their money in bonds. If they're scared to put their money in stocks, they put their money in bonds. So, I think the municipal bond market in China is very, very limited, and it's very hard for retail investors to access. So I would say, as an investor looking at real estate in China, I would be very nervous. I think tier 1, maybe part of tier 2, it might stay up for just because there is that income support. But beyond that, if these job losses, which are coming down the pipe, they cannot be avoided, and there is such an oversupply, it's not clear that, I don't know, I don't think you could get good returns.
Definitely the bond market is really not developed, and that show up on banks' balance sheets. And they are going through this LGF debt, local debt swap, and now they'll try to develop that as one way of deleveraging. But as you said, this is one of those processes that will take a while to.
Well, you remember back in the 90s and in the 2000s in the US, in the 90s in Japan and in 2000s in Europe, in the US, people made a lot of money from distressed debt, right? Because the banks wanted to get it off their balance sheets, and people bought it, and Goldman Sachs made a ton of money in Japan that way. So now the banks have gotten smart. They don't necessarily sell the debt. They'll hold on to it, figuring that if they can make it through, the prices will eventually come back. But what is going on here is that in China, the government has said, and rightly so, that if any money is to be made, we want to make it, right? It's not the banks or the private investors. So it seems to me there's no distressed debt play in China. The only way to play it is probably through the asset management companies. The state-owned asset management companies, because they are the ones that are buying at 10 cents on the dollar or whatever, and it should recover. And frankly, if I were looking for distressed debt today, I would go to Europe, because the European governments are still not allowing that sort of thing to go on. I don't know what you think went on, George.
Can I add something to this?
Mm-hmm.
I recall in about '97 when Hong Kong went through the same kind of approach. And in Hong Kong, confined market, it did work for Hong Kong. And eventually, the government of Hong Kong made money when the economy turned around. I fear, though, that this is not a good lesson for mainland China, that they have taken this approach. I don't know. I don't see it as best for the economy itself. I also have two questions. One is, I know that the national government puts money to help start up companies, and I'm wondering out of what bucket that money comes from. Secondly, there's a very large capital, I have to watch my words, a very large surplus of as George pointed out, the numbers are huge, 3.9, $3.8 trillion. What's being done with that money in terms of, is any of that money going into rebuilding the economy? Is it going into buying securities, or are they using this as a policy tool, in an international relations policy tool? So, several questions.
This is a very controversial topic because it comes back to the whole issue of capital flows. I've heard from people that the surplus is not actually what people say it is, that the reported numbers are not the reality, because there's systematic, I don't know if I'll get this right, under invoicing of imports and over invoicing of exports so that you can get money out of the country, and that it's a very large amount taking place, particularly through Hong Kong. So, I think that it comes back to capital flows. I don't know what they do with the surplus, honestly. I have no idea.
Well, the reserves peaked at 4 trillion, and some years ago, China actually recapitalized some of the financial institutions, and they did that using some of their reserves, operation called central fusion.
Were those the major, 3 or 4 major banks that you're talking about? Or
yeah, they recapitalized all the banks. And just to remind, under Zhu Rongji, something like 50 million people lost their jobs. I mean, it was a massive restructuring. So China has done this before. The concern in China at one point was that the reserves were too high, okay? And what they were doing, when you have foreign exchange reserves, you look at safety, liquidity, and return. The primary reason for reserves is for rainy day, if you have to the economy, drought, and also to support the currency. They had a lot of excess reserves, which they put into like China Investment Corporation. And actually, interestingly, Chinese officials said that when looking at China's reserves, one should consider not just those on the balance sheet of the PBOC, but also those of CIC. Now, China historically released the data on its reserves with some delay and did not correspond to something known as the Special Data Dissemination Standard of the IMF, which is basically a framework like generally accepted accounting principles for releasing your data. As part of internationalizing the RMB, China now subscribed to that, and that means that roughly within a month or so, at the month end, you get up-to-date, presumably accurate data. Just one other aspect about the usage of reserves. The Asia Infrastructure Investment Bank and the BRICS Contingent Fund were, of course, Chinese-led initiatives, and this, both the going out strategy as well as the Silk Road, One Belt, One Road, are a very major initiatives now. I mean, the China Development Bank is much larger than the World Bank.
Could I ask one more question? Because the SOEs, some of them are very large and own for-profit companies. And so this is apparently an outlet for some of the government funds to go through those large SOEs and could conceivably distort the picture in what's happening in China. So that goes into the ownership of those properties. Do you see that? How do you see that issue? Have you thought about that issue?
You're the stock picker. Do you own any SOEs?
I don't own any.
Right. My issue, what I'm referring to, is the fact that they do have access to funds and that they can put into their ownership into the for-profit operations. And is that distorting the economic picture here?
Well, it's on a small scale, it's probably true, but I think capital control, well, with the impossible trinity, it's, if I look at the three components: interest rate, the exchange rate, capital control. I think if we really have a severe downturn, I think the capital control is the one that's the easiest one to get done. Which, especially if US is going into a rising cycle, China can't just keep on reducing their interest rate with exchange rate not being impacted. But anyway, I just want to go back to Liz to go on with the question.
Sure. We will talk about a lot of the kind of macro. Maybe I pick up a sort of a micro question from the list here. The question is, you mentioned about having rule to meet the consumption upgrade. How do you find quality companies that will have sustainable business model? And that's kind of what we do on a daily basis. So I want to, put that question out there. And like to answer that? Sure. Oh, do you want? Sure. Well, that's kind of what we. So our company do as a kind of what Peter just mentioned. So thanks, Peter, for setting up. We are sort of launching ESG investors. So we look at company. We try to focus on companies that more exposed, especially in the emerging market fund, exposed to more consumption, access to capital, financial company, insurance company, for example. So those, and then we believe that in emerging market, the corporate governance actually can be a sort of alpha factor rather than just a risk factor, which is sort of the consensus more in the developed market. And try to be longer term. So essentially finding high quality companies that have more shareholder interests aligned and be in the segment that has end demand growth. So that's kind of how we do it. And actually, it's kind of funny that a lot of the things that Peter just mentioned in terms of water, so we own a water purifying company, I won't mention the name, but so kind of try to find companies along those things and probably be willing to pay up a little bit, but with very mindful in terms of valuation. So that's kind of what we do. That's our company have a sustainable emerging market fund. I'd love to hear any other thoughts.
Well, I would just say that there's a lot of career opportunities in securities analysis in China. 2,400 A shares or something like that, and maybe 500 to 1,000 are considered investable. But since China joined the WTO in the early 2000s, there has been an enormous amount of resources devoted both to sort of macroeconomic analysis in China, but also to the Asia market. The securities industry is very much in a growth mode. There are a lot of good opportunities, as Gita mentioned, but I still think that there are a number of companies that are under research. If you look in the United States, for example, in small cap equities, there's an index known as the Russell 3000. Well, there are many stocks, small cap stocks, that only have 1 or 2 analysts following. So China's got a long way to go in terms of, and it presents a lot of good career opportunities.
It's like the Wild West.
So,
yeah,
I think stock picking is one of the most fun things you can do because it's not something that you really need to be a professional doing every day. But most of the times, if you actually know an industry, you can probably identify who is the best positioned company in the industry. And the key things to really add to that analysis on the business side is really to understand a bit more about what's embedded in the stock price. Sometimes stock is a terrific company, but it's priced for perfection. Sometimes it can be priced actually very low because the Wall Street is actually very bearish on it. If you can have both, then I think you have a luxury of investing in it when there is fear in the market. One of the companies Gita mentioned was C-Trip. I remember the company, well, the stock is actually doing very well for the last 2-3 years. But at one point, I think it's 2012, the stock dropped from 60-70% in 1 year because there was a price war between Elon and C-Trip. And then everybody was afraid, okay, they're going to kill each other, they're going to all burn cash. And the stock, I remember a single day, the stock went to $12, and they do have $12 cash. So there you go. But did I buy the stock at the day? No, I didn't, because I already own it on the way down. But if you are an individual investor and you actually use the service and you actually look at the stock, that may present you an opportunity that pays for your tuition.
I think Wenmo has a very good point to make the distinction between a good company and a good stock. So a good company is a good business, but you can have bad companies that are great stocks. So as a more quantitative person, I say my portfolio, I want to have some bad companies that are great stocks, and I want to have some good companies that are good stocks. Because it's all about the timing. It's the price, right? It's the price that you buy at, and you can find the right price at which to buy a bad company as well.
So in the meantime, we're probably going to do one more questions.
Yeah, let's have one or two more questions.
Maybe I'll just ask one here that's probably going back to the currency, because I still think that, at least in my opinion, that's still a key question for emerging market banks in the foreseeable next 2 or 3 years. Would you agree that a one-off, quick but moderate, sharp currency devaluation is still most likely approach that?
No, I don't think so. Unless we find ourselves in a situation through some policy mistake that the reserve losses are running at $150 billion a month or something like that. But there's been a conscious policy to support the currency. The degree of overvaluation, I think, and Zhu Xiaoxuan and many others have said they don't think the currency is overvalued and that they're going to take steps to defend it. I don't think that there's a fundamental disequilibrium, except for the political dimension, right, in terms of anti-corruption campaign, people wanting to get money out of the country, and of course the pace with which the bad debt problem is dealt with. So are we going to have a Japan-like economy, or is it going to be brought to a boil quickly? I think what's going to happen, and probably the best indicator, although it's always wrong, is the forward market. But at one point, the forward market was saying 6.95 to the dollar in January, and now we're at 6.60. I think we're going to see a gradual sort of crawl down of the market.
Maybe I'll just add quickly to George's point, because the sort of the reduction of the reserve, let's call it 100 billion. So that's a key, something to watch and see if that's accelerating or not. And one of the key reasons, I also Peter pointed out, so a lot of the capital flow right now, at least from the data so far, half of which is Chinese domestic company doing the reverse of the carry trade. They pay down their debt that is denominated in US dollars, right? And then get those debt in
RMB. So that will show up as sort of capital outflow. But so you can, if that process try to, unwind yourself, well, that's mostly done, then the pressure on the capital outflow may be reduced. So with that, I think we should wrap it up. And thanks very much to all of you for the discussion.
Thank you so much. We did cover a lot today, from the macro view to the fundamental stock picking to the how to connect from a quantitative perspective to see how the economy impacts persons and every people's day-to-day job, day-to-day life. And this is a very interesting discussion. I hope you found this useful to you as well. I hope you got your own answer about the hard landing, soft landing, or it's just a bumpy ride. So, as Yimin mentioned, BCIC and the TCFA have many ongoing events throughout the year. If you're interested in this, please contact our volunteers afterwards to be added on the mail list to know more information about BCIC and the TCFA. Please join me to thank our panelists and our moderator again, and thank you HCSSA, thanks TCFA, and thank you our volunteers who made today's session so successful. Have a good night. Thank you.